The market. You have to be 18 when you buy. You have to buy through a broker, right? The broker is licensed with either New York Stock Exchange, American Stock Exchange, NASDAQ, all three. You've got to go through a broker. There are fees, usually small fees. I forget what I pay, but they're relatively small, right? You pay more in taxes to the government. When a company first comes out with initial product public offering, IPO, such as with Google back in the 90s, I think it was, they will go with large financial corporations, and also the Security Exchange Commission, I think, or the FTC, and they'll underwrite that stock, right? They'll agree on the value of the stock at the initial public offering, they'll underwrite the stock, and they'll offer it in the primary market where large financial institutions and brokers buy it, right? You can buy it there, but you have to fill out a special application to do that. But typically, it's large financial organizations that buy that stock, brokers and so forth. Period of time goes by, and they offer that in what's called the secondary market. That's where you and I buy and trade, okay? That's where you and I make our money. That's where we mostly do our investments. We, depending on the stock, we buy through 3 exchanges. There's actually 2, and one is a over-the-counter exchange. But you have the New York Stock Exchange. This is where the large, or usually the most profitable corporations are. Then you have the American Stock Exchange, smaller companies, a little bit more riskier. You'll find IBM, GE over NYSE. You'll find smaller companies in the American Stock Exchange, Amex. But most of the volume, not necessarily the largest companies, most profitable, but most of the volume of trades are done on NASDAQ. That's over the counter, purely online. It's a group of brokers that purely deal, you never see them, but there are basically online transactions, OTC. A broker could be E-Trade too, right? You put money in an account and you pretty much do your trading yourself. There's some fees with that, right? But this is over the counter, purely online, a lot of volume, as you expect. These are through brokers in the New York Stock Exchange, American Stock Exchange, okay? That's how it works. And then you do it by mail, web. Most cases, you have a broker online, just like you did with the stock market game. You do a market order, which is you want to buy it at the current market price or sell it at the current market price. A limit order, which is you set the price, and when it hits that price, it's not guaranteed, they're going to make the seller buy at that price. Or stop order, when it's within the range of that price, next available time the market's open, you get that price. Right? Right, Emily? Okay. All right. Select a strategy now. Remember, when you invest, I'd recommend a long-term strategy. If you're buying every day, and you're freaking and things like that, you know, you're buying every day, you're selling every day because you're afraid you're going to lose money, or you want to get it, you're thrashing, you don't know what you're doing unless you're a broker. Take the long term. 2 strategies for long-term investing. Dollar cost averaging. When you guys are making your big bucks, give your broker $10,000 a year, come January 1st or whatever. And what you're doing is you have your portfolio, you love it, you did all your research, you know, you're doing pretty well. You're not afraid of those ups and downs because you're a long-term investor, right? And you put $10,000 account every year, and what you're doing, you're just spending on those same stocks, but you're letting the value of the dollar dictate how many shares. It's a beautiful thing. You're letting the economy regulate what you buy. I should say how much you buy. That's a nice thing. Dollar cost averaging. And I recommend it to you, dividend reinvestment. You know, don't spend the money. Even if you guys get a bonus, right, when you're working, when you're with a corporation, or you started in a corporation, you're very wealthy, give yourself bonus. Make believe you never got it, put it in the bank. Put some of that towards investments. It doesn't hurt that much, right? But dividend reinvestment, don't cash those checks in that you get every quarter. Reinvest it. Buy more shares. Let it grow. Now, short term, I don't recommend unless you really know what you're doing, okay? But we talked about short sell, buy to cover, buy on margin. Those are the 3 primary short-term techniques when you buy and sell stock. On short sell, you're borrowing stock from your broker. You think you know what you're doing. You're selling it at a high. You've got to return that back to your broker. He's charging you fees, or she's charging you fees. If it never goes lower, when you have to buy it back, return it, and keep the profit, or it goes higher in terms of value, you're kind of in trouble. You're paying out of your pocket. You're going to reduce your equity. I wouldn't recommend it unless you really know what you're doing, right? That's short sell, buy to cover. And then buy on margin, you're borrowing against your equity. We talked about that, right? It's like getting a loan against your equity. And it's almost like increasing your liability. Avoid it unless you really know what you're doing. But I just wanted you to know what those techniques are. All right. I think we're done. So what I want to tell you, as we exit stock, we're going to go into bonds and mutual funds. I think you're ready, guys. As they say, go forward and prosper. Okay? You know more than 80% of the world about stocks now, I would think. But have fun with it. All right. Thanks for your attention. Thanks, guys. Okay.